Good evening or good morning, wherever you are in the world. Welcome to the next video lesson here. Just a quick one. We get asked all the time by the members of when's the best time to sell a call option, what strike price, what month. So let's start with the very basics. We all know the shares are either going to do one of three things. They either go sideways, they do 3 rolls sideways, and then usually change direction. If they go up 3 rolls, and then they usually change direction. And even when they want to go down, it's exactly the same thing. They tend to go down in not in a straight line, but they tend to go down in 3 rolls, and then they change direction. Let's see if we can get a red color here to show you this. And again, you can see they go down roll 1, 2, and 3, and then they change direction. So from this basic principle, we know the best time to buy shares or sell puts is to buy at to have the patience to wait for the 3 rolls to happen and to wait at the bottom of the 3rd roll. That's always the best time to get ready to purchase or sell a put option to generate income. Therefore, the opposite of that, the best time to sell is sell at top of 3rd row. So again, wait patiently for the 3 rolls to unfold and sell here at the top of the 3rd row. Well, that's simply if you're buying and selling shares. What about if you're like a Warren Buffett, you're long-term buy and hold, but you also like to enjoy income along the way? Well, the best time to sell call options is at the top of a roll, and the best time to sell put options is on the bottom of a roll. Same with the sideways trend. The best time to sell calls is at the top of a roll. Best time to sell puts is at the bottom of a roll. And exact same for a share that's dropping. Best time to sell calls is at the top, and the best time to sell puts. If you don't want shares to be put to you, make sure you sell the put and buy it back at the bottom. So the goal is that you're going to hold on to your shares long term, and while they do the journey, no matter what direction they do the journey in, you want to be selling the calls at the top points of that journey, and you want to be selling puts at the bottom point of that journey, so you can make money. Everything we're showing you here is very well described with loads of diagrams and examples in our book, so you want to be financially free. So if you want to check out tisn.ie/books, download the book called So You Want to Be Financially Free. So this is the foundation information we need. Also, you can back it up with 3 indicators. So we have indicators that tells us when the 3 main indicators we use that tells us that when shares are at the bottom is one of the ones is called the MACD bars, which basically get larger and larger and larger, and then all of a sudden they begin to get shorter, and that is what we call the hidden strength. So we're looking for a build-up of strength. The second indicator that we use is what's called the stochastics, which is it's like a box, and it's got 2 critical lines. It's got your 80% line, and it's got your 20% line. And again, when the stochastics is below 20, but then it shows you the V for victory, that's when you get interested in it. And the third indicator that you're interested in, as well, as what's called the RSI. Again, it's a scale of 0 to 100. And again, the critical points are, you're going to have a 70% line. You're also going to have a 30% line. And again, when you look at the line, again, you want it to be below the 30, coming back up through the 30, making a V for victory. So combination with that information, obviously the opposite of that is the best time to sell calls is at the top. When you've been above 17, you make the upside down V. Same with the stochastics, when you're at the top and you make the upside down V. And the same with the RSI bars, when you've made loads and loads of very tall bars, and then all of a sudden you begin to show that, what we call that hidden weakness. So in summary, combining your knowledge of charts, counting the number of rolls, identifying your direction, and then backing up with your indicators, the best time to sell calls will be at the top, and the best time to sell puts will be at the bottom. So combining your three indicators with your trend and direction, counting number of rolls, you have a good idea of when the best time to do it is. The next key question is, which put will I, if you're selling calls, which call will I sell? Well, generally speaking, proactively, the maximum opportunity to sell calls is at the top of the third roll, as we said here. And then the question is, well, what tends to happen when a share price changes from an uptrend to a downtrend? What it will do is it will gravitate back to a previous low, then it will go back up again, then it will gravitate back towards a previous roll, and then go up again. It will gravitate back to the place where it started at back here, and then that will be the end of the three rolls down. So whenever you're studying a chart and you're saying, we're up here at the top, we anticipate it's going to drop at least to here, but now that it's done three rolls up, it's probably going to gravitate back to previous lows. So that's the strike price that you agree to sell the call at, because you can collect all of that fall before it happens. Same with a sideways trend. If you anticipate it's doing a sideways trend and you're up here at the top, and you anticipate it's going to drop down here to whatever that strike price here is, that's the best one to sell. And the exact same when share prices are dropping. You identify the next lowest price, and that's the strike price you sell. The last piece of the equation is, well, how long, what month will I sell? You'll study the trend and you'll see, well, how many months do I think, or how many weeks do I think it's going to take to fall? So in this example here, if you're selling the call option up here, at this point here, and you anticipate that the next low is going to be down here, where the price is down here, then you just look at your chart and say, how long do I think it's going to take in terms of time? As time moves on, how long do I think it's going to take to drop? So for example, if you're in the month of March and you think it will drop, not in April, it will finish falling not in April, but will finish falling by May, you would do a May call. So if you think it's going to take 4 to 6 weeks to drop, you'll do a 4 to 6 week call option. If you think it may take longer to drop, you'll do a longer option. So that's the theory. Let's now look at the real world. Let's go to some examples of charts where we can take a look at this. So let's just go ahead and share this one here. And we can just stop the video here so it's not in the way. So we'll stop the video. So this is an example of sketches. And again, we can see we've clearly got the three rolls up. Let's just get the drawing tool. We can see we've got roll number 1, roll number 2, and roll number 3. So here you are now at the top of the third roll. The share price is trading at $44. And in our experience, after 3 rolls up in a particular direction, the share price is probably going to drop to the previous low. In this case here, the previous low is 30. So if the share price is at 44, and if it has done 3 rolls up, and it's up the top of the third roll, and there's a strong possibility it's going to certainly go back down to the support price, which would be around about 36. But after 3 rolls up, there's even a stronger possibility it will drop further back to the previous low. That would be $30. So you would sell an in the money $30 call option. So if you sell to open, when the share price is up here at $44, if you sell to open a $30 call, when the share price is at 40, the share price is at 40, and you sell to open a $30 sorry, at 44, and you sell to open a $30 call option, when you're going to collect at least $14 of premium. So rather than you watch the share drop from 44 all the way down to 30 and don't do anything proactive about it, you can proactively collect $14 of real value plus some time value in that option. Same here, when the share price is here at the top of the second row, you look at it and the share price is around about 40. And you anticipate it's going to drop down to the next previous support, which is 30. So again, at 40, if you sell to open a $30 call option, you collect plus $10. Same back here when you're at the top of the first row, and the share price is trading around about 36, and you anticipate the next low is going to be around about 28. So at 36, if you sell to open a $28 call option, you're going to collect the difference between the two, in this example here, plus $8. So you just read the trend, anticipate the next drop, and before the share price drops to that level, you can collect the fall before it happens. So in this example here, you've collected 8 plus 10 plus 14, so it's 24 plus 8 is $34. So you've collected $34 of income during all those drops. And maybe you bought the share back here when it was back down around about 22. So with a $22 investment over the period of a year, or in this example here, we're looking at a year, pretty much over 12 months, you have collected $34 income on a $22 stock. And that's how you stay in the stock. Well, obviously you will buy back the option here, buy to close here at the bottom, buy to close here at the bottom, and buy to close here at the bottom. So let's say it costs you $2 every time you do it. To buy back, you will net minus the $6 the cost to buy to closing, you will net around about $28 on a $22 stock, and you still own the stock for the long-term buy and hold. So sell the call at the top, buy back at the bottom. Sell the call at the top, buy back in the bottom. Sell the call at the top, buy back in the bottom. So what you'll notice about this is it takes a whole 12 months to unfold. So you just got to be very patient. You get an opportunity 3 or 4 times a year to get that excellent call option premium. You get an opportunity to buy it back, and then be ready to sell the call option when it rises again. So that's one example. If we take a look at another example, let's make sure we're sharing it. Make it full screen. So here's a proactive example. So the shares here in this example here, shares have gone up, come back down, gone up, come back down, and they're up now. So now that you're at the top of the third roll here, top of third, you anticipate it's going to drop at least to here and probably back to the previous low. So $24 will be a strike price you would sell. Then it could rise again and then drop to 22. That would be the next price you sell. Then it could rise again and drop to 20. So what you're doing is just going back to previous significant points in the graph and identifying the strike prices. So the strike prices you choose are typically the previous significant lows. And again, you got all the signs here. You got the upside down V in the stochastics, upside down V in the RSI, and you got the hidden weakness in the MACD bar. Take a look at another example. Again, we'll maximize it. Make sure you can see it. So in this example here, it's already dropped. So it's done roll number 1, roll number 2, and roll number 3. So up here, you would anticipate that it's going to drop to at least here, but more likely go back to previous lows. So this example here, you're selling at 20. And then you buy it back. So you sell to open up here. When the share price is sitting at around about 26, you anticipate it's going to drop out of the uptrend and drop back to at least the previous lows. You've got loads of examples here, or loads of warnings here, the upside down V in stochastics, the upside down V in RSI, and weakness in the MACD bars. So you've got loads of signals here, both from the very factor at the top of the third row and the fact that your indicators are very high. And so when it's at 26, you would sell a $20 call option. You're going to collect at 26. When you sell to open a $20 call option, you're going to get at least plus $6 of time of real value, plus whatever time value is there. Then down here you buy to close it. When it goes back up again to around about 22, you anticipate the next low is going to be back at previous lows here, back at around about 18. So you anticipate when it gets to 22, it's going to drop. And how do you know that's it? When it gets up to around about this 10 and 20-day moving average, it's done one roll back up to recover. And then you say it has the potential to drop down to 18. So again, at 22, when you sell to open, an $18 strike, you're going to get the difference. 22 minus 18 is plus 4 of real value, plus whatever time value. Again, down here you buy to close. Next thing you anticipate is going to rise back up to resistance, which in this case will be around about 20. And then if the third roll follows through, it has the potential to drop back down to 17, which is a very strong support price. Back here, back here, back here, and back here. And so at 20, when you sell to open a $17 call option proactively, you get plus $3 of time value, plus $3 of real value, plus whatever time is left over. So when you do your sums, you got $6 here, $4 here, and $3 here. You got a total of $13. Let's say it costs you $1 every time you buy to close, minus the cost of buying to close. You're still going to make about $10 while the share price drops. So let's say you bought the share price back here at 17 at low points before it did the 3 rolls up. So with a $17 investment, you collected $10 of income and you still own the shares for the long term buy and hold. So again, sell to open at the top, buy to close at the bottom. Sell to open at the top, buy to close at the bottom. Sell to open at the top, buy to close at the bottom. Sell to open, buy to close, sell to open, and buy to close. So you're back to square one. You bought the shares back here at 17, they're back at 17, but you've collected at least $10 of income. Again, you got to be patient. It takes maybe a month to rise, a month to fall, a month to rise, a month to fall, a month to rise, a month to fall. So that's 3 examples of reading the trends, counting the number of rolls, anticipating the next drop based on previous price activity, proactively selling the call when you're at the top of a roll, and then buying it back when you're at the bottom of the roll, and keeping the difference in your pocket. Again, the month is always going to be the month you think it takes to drop. Typically, you give it about 2 months to get to where you think it's going to get to give it time to mature and time for the time value to evaporate away, so it's fairly cheap to buy back. So hopefully this has helped you anticipate when the best time to sell calls is, the best price to sell, and the best length of time to do it in. Enjoy your lesson, and we look forward to seeing you in the next video lesson.